Assalamualaikum and hello everyone. Welcome back. We are going to proceed with the preparation of consolidated financial statement for simple group structure, and our focus today is to start discussing the consolidation issues in the preparation of financial statement. So we are going to start off with the adjustment that are needed should there be any fair value adjustment and recognition of unrecognized assets of the subsidiary company. And this happened on the date of acquisition. For details, please refer the textbook. I'm referring to company accounts and group reporting by Jane Laza. You can refer to page 357 to page 369. Particularly for more details, you can refer to example 9, page 359. That one is your self-study example. I won't be going through that self-study example because I'm going to show you my own work example. Okay, let us focus on fair value adjustment and recognition of unrecognized assets of subsidiary. On consolidation of financial statement, is the parent that has to recognize all assets of the subsidiary at fair value. So if the subsidiary's assets are shown at the carrying amount, and if the fair value is available, the parent company will have to recognize all assets of the subsidiary at fair value. So therefore, because it has to recognize at fair value, two issues may arise. Number one, the issue is that the fair value of the asset and liabilities in the subsidiary company may be different from their carrying amount. You can find this in the textbook, right, as well. And the second issue is that the subsidiary itself has not recognized some internally generated asset, or some asset are not recognized in the subsidiary's own financial statement. So for consolidation purpose, what parent will do is parent will have to revalue the asset of the subsidiary for consolidation purpose. Therefore, the fair values will have to be recognized in the consolidated financial statement, or I put here as CFS. So the fair values of the subsidiary's asset will have to be recognized. It shouldn't be the carrying value. And therefore, to adjust the asset of the subsidiary from its carrying value to the fair value, there will be also adjustment needed for a recognition of increase or surplus on revaluation, or maybe a decrease or deficit on revaluation, if you compare the carrying value with the fair value. And the consolidated financial statement need to reflect this fair values. Yeah, it has to reflect the fair values. So therefore, if there are a surplus or if there is a deficit, that surplus or deficit on the subsidiary's asset, which arise on the acquisition date, is considered as pre-acquisition reserve if it's a surplus. If it's a deficit, it will be considered as pre-acquisition deficit. It will be treated in accordance with MFRS 116 on how you treat surplus and deficit if it's the first or initial revaluation. And since the surplus and deficit is the one arising on the date of acquisition, therefore, it will be included as part of the pre-acquisition reserve, pre-acquisition surplus, pre-acquisition revaluation reserve. And therefore, it has to be included in the calculation of the fair value of net asset in your proceed of calculating the goodwill. So this will affect the calculation of goodwill later. I'll show you that. Okay, on top of that, if you are talking about depreciable asset, you are not just going to adjust for the surplus or deficit, but you also need to make some adjustment according to the requirement of any surplus or deficit. The depreciation adjustment need to be made. Right, need to be made to see whether should there be any increase or decrease in depreciation charge increase. For example, if let's say the depreciation of the subsidiary based on the carrying amount was under provided, so you should have increase or provide additional depreciation. Or if it's a decrease in depreciation, this will normally happen if you come across the deficit on revaluation. So for deficit on revaluation, normally you need to go and reduce the depreciation charge. If it's a surplus on revaluation, you will have to provide more depreciation because the depreciation of the subsidiary was being under provided. And this has to be made to reflect the group depreciation. So the difference in depreciation must be adjusted so that we only reflect the group depreciation, which are based on the fair value on the measurement date. Okay, the measurement date here is the fair value on measurement date normally is the fair value on the date of acquisition, because that is the date that you acquire the subsidiary and do the revaluation. Okay, for some note for you here, if you can see, what you are going to adjust would be later is the depreciation, and only the accumulated depreciation from the date the shares were acquired or the date of acquisition, or I put here as DOA, will remain in the accumulated depreciation account. Those that were before the date of acquisition, the accumulated depreciation before the date of acquisition that has been provided by the subsidiary, that will have to be eliminated. So let's look at our example. Before that, we have another second issue here. This is on some asset that were not recognized as an asset in the subsidiary company, because that is considered as internally generated asset. So if you can recall MFRS 138, internally generated assets are not recognized in the financial statement. However, for consolidation, this asset, this internally generated asset of the subsidiary, you can refer to the textbook as well, they are considered as separable and identifiable. So because they are considered as separable and identifiable, they will now be recognized in the consolidated financial statement. So it's the parent that will recognize that in the consolidated financial statement, the asset of the subsidiary. Okay, that one is available. The explanation of that is available at page 357 for more detail on this. So parents will have to recognize this asset in the consolidated financial statement. So let's say you have internally generated customer list, internally generated brands, trademark that were that of subsidiary that was not recognized earlier in the subsidiary's own financial statement, but now you have to recognize in the consolidated financial statement, and that is done by the holding company or the parent company. So let's look at our example. Our example will show all three, the two issues that I mentioned. So let us look at this example. This is work example 1 for your information, and work example 1 is trying to illustrate the fair value adjustment and unrecognized asset of the subsidiary that are now being recognized. So we have a company called Hammock Berhad, acquired 80% of ordinary shares of Shanty. So the acquirer is Hammock, and Shanty is the acquiree, so it's a subsidiary. So 80% was acquired, so this is assumed to be a control, and 20% remaining that was not acquired belongs to the non-controlling interest. And the date of acquisition is on 1st of July year 2. So this is the date of acquisition. Date of acquisition is this, 1st of July. Right. Let us look at the information given. Yes, 194,000. So the consideration transferred for the acquisition of ordinary shares was 194. At the date of acquisition, which is 1st of July, the balance on the profit and loss account or the retained profit balance of Shanty, this is the one of the subsidiary company, is showing a figure of 22,000. And the general reserve account of Shanty, the subsidiary, was 14,000. So these two figures in orange box here, these they are actually the pre-acquisition reserve. The acquisition of 10% preference shares, there were also acquisition of 10% preference shares and 5% debentures. It also took place at the same date. So meaning that the date of acquisition was also on 1st of July, year 2. And you are given the statement of financial position of the company as at 30th of June. Okay, so if you have the detail here, you have the detail of the consideration transfer or the cost of investment for ordinary shares, the one in red. The one in blue here is the cost of investment that you have transferred to the subsidiary for the acquisition of debenture. And this is the one for preference shares. And you are not informed what is the percentage of preference shares being acquired and what is the percentage of debenture being acquired. You may have to calculate yourself. How do you calculate that? You will calculate it by comparing with what you have acquired, right? What you have acquired here is given here, 20,000 for the debenture, and that 20,000 is out of the total 50,000 debenture. So 20,000 out of 50,000. So that was 40% acquisition. So we will calculate that. The next one is for the preference shares. So if you look for the preference shares, you acquired 60,000. 60,000. And the total preference shares in the subsidiary was also 60,000. So meaning to say that you have acquired 100% of the preference shares in the subsidiary, leaving no non-controlling interest for the preference shares. For the preference shares, it was 100% acquired by the parent company, Hammock. Next, so the rest are just information on the ordinary shares of the subsidiary company, and we have been informed that we acquired 80%. So if let's say you are not informed, you have acquired 80%, the way you do is by looking at this 80,000 ordinary shares and compare with the 100,000 shares in the 100,000 amount in the subsidiary company. So you can also find the percentage by comparing 80,000 out of the 100,000 carrying value. So with that, you would get the percentage acquired, assuming the units are also 100,000 units. Why? Because here no information is given, so we assume the fair value is 1 ringgit. Right. Okay, we have done that. So let's look at what we should do first. Of course, if you were to do the workings for the acquisition of the ordinary and preference shares together with the acquisition of debenture, you will be able to get this as your answer. So the percentage of ordinary shares acquired, 80%. The percentage of holding non-controlling interest was 20, and there are none that is applicable to other debenture holder because they have NCI. For the preference shares, 100% was acquired, no non-controlling interest. For the 5% debenture, 40% was acquired, and debentures are not shareholders, so they don't have non-controlling interest. And here is the percentage that are held by other debenture holder other than the parent company. So let's look at the adjustment that relates to adjustment on fair value adjustment. Okay, if you look at additional information number A, The machinery of Shanty Berhad was revalued to 95,000 on 1st of July year 2. Remember, 1st of July year 2 is your date of acquisition. Yeah, so it was revalued to 95,000. So if you check here in the asset section here, the machinery has a cost of 85,000 and it has an accumulated depreciation of 32,000. So now it was revalued to 95,000 on 1st of July. But the figure given here is as at 30th of June. So to find the revaluation surplus or deficit that may arise, you need to compare this fair value with the carrying value on the same date, 1st of July year 2. So this is not given, you have to find. So the revaluation was not recorded in the books of Shanty. So meaning that the subsidiary did not adjust for this revaluation. And depreciation that has been provided by Shanty was at the rate of 10% per annum on straight line method. So Shanty uses straight line method. Now there has been no acquisition or disposal of machinery during the last 2 accounting periods. So we will have to do some adjustment to reflect the surplus and also the change in depreciation and how that will affect our consolidated financial statement. That was the first one. The second one is the case where you are talking about a building. The first one was on machinery, the second one was on building. So you have the acquisition date where the parent company revalued again the building of Shanty, the subsidiary, at 200,000. 200,000 is the fair value, and on that date means on the date of acquisition, 1st of July year 2, the remaining life of the revalued building was 5 years. So it was 5 years on 1st of July year 2. No record has been made in the subsidiary company book, and depreciation was to be provided on straight line method. So again, straight line method. You may also be tested or should also know how to adjust for the reducing balance method as well. And there are no acquisition of disposal of building during the last 2 accounting period. Why 2 accounting period? Because you acquired on 1st of July year 2, and now you are already going to see that the reporting date would be, when was it? The reporting date is as at 30th of June year 4. So it was from 1st of July year 2, the date of acquisition, and 30th of June year 4 is the reporting date. So therefore that will mean to be 2 accounting period already, or 2 years. 1st July year 2, there's another one. Hammock recognized and internally generated customer list of Shanty. So before this, internally generated customer list or internally generated asset cannot be recognized because it was not separable. It does not arise through business acquisition. But here, you would see that internally generated asset of Shanty was valued at 5,000. So these are the fair value of the customer list on the date of the business combination. And the asset has indefinite useful life, meaning that there were no amortization of customer list. You can also have an intangible asset that has definite useful life. So for definite useful life, you may have to also consider doing some amortization adjustment. But here none is needed for the amortization because the asset has indefinite useful life. It was valued at 5,000. Okay, let's look at what we need to do. We need to prepare the consolidated statement of financial position of Hammock and its subsidiary Shanty as at 30th of June year 4. Before that, we need to do a few workings. Let me just show you this in some timeline. So if I mentioned earlier, the date of acquisition of the subsidiary was 1st of July year 2, and the reporting date was 30th of June, year 2. So it has been 2 years. 2 years after acquisition, now you decide to consolidate. On the date of acquisition, these are the net asset of the subsidiary that were available, where you have the profit or loss, also known as here RP, retained profit of the subsidiary, or the pre-acquisition profit 22. Where do you get this? You get this from the information given in the question. You get this here, 22 and 14. Okay. Next, general reserve of the subsidiary was 14,000. This is also pre-acquisition reserve, and this is part of net asset. So this will have to be included in the fair value of net asset calculation. And one more thing that you need to notice is that we also will have some asset revaluation reserve as a result of the surplus or deficit that will be done for our machine and building just now. For your information, in this question, it will relate to surplus. So there will also be some asset revaluation reserve of S on the date of acquisition, but we do not know how much. We do not know. We need to go and find out that. Right. So the same thing that you need to do for general reserve, you need to find out that a figure for asset revaluation reserve. How much is the pre-acquisition surplus? Because this question is about surplus. So the first thing to do is we are going to do it according to the asset. Let's start off with machinery. For machinery, first step is that you need to find the revaluation surplus or revaluation deficit. So either revaluation surplus or revaluation deficit. But in our case, we are trying to find the revaluation surplus. So I'm putting that surplus there. Of subsidiary that has not been recorded on the date of acquisition. On the date of acquisition, again, date of acquisition is on 1st of July year 2. So on date of acquisition here is on 1st of July year 2. Okay, 1st of July year 2. Right. Next, so to do that, you need to compare the carrying value with the fair value. So let's look at what is our fair value. Okay, that is our fair value. Our fair value given in the question, as we have already noticed earlier, is 95,000. That fair value was 95,000. Okay, there is no journal entry for that fair value because we don't do journal entry for fair value, right? Okay, the next thing to do is to find out the carrying value. To find the carrying value on 1st of July year 2. To find the carrying value, you have to do some backward working. The reason is because you are not given the carrying value on this date. So you need to find the carrying value here on this date. You also need to find what are the accumulated depreciation. I put there as AD on this date as well. You need to do that. Right? So you need to find the one on 1st of July. You are given the information on depreciation here. Depreciation straight line method was given in the question, so I just put it here. And you are also given the accumulated depreciation of machine to be 32,000, right? So these are the things given. You do not have information on carrying value here. You have the information on carrying value on the 30th June year 4. So on reporting date, these are what you have. Given in the question. The retained profit as per the reporting date was 60,000. Where do we get this? It was from the statement of financial position of S, retained profit of S, and the general reserve of S also from the statement of financial position of S, 24,000. So now let's find what is the carrying value. To find the carrying value, what you will do is you're going to take the cost. The cost of the asset is given in the question. Where do we get the cost? The cost of the machinery was 85,000. So that was the cost of the machinery. Remember, we are doing for machinery. So the cost, put the cost here, 80,000. So to find the carrying value, it is cost minus accumulated depreciation. So accumulated depreciation that you will have to adjust would be from the date of acquisition, which is from here, 1st of July, year 2, up till reporting date, which is on 30th of June, year 4. So to get that, you need to find the accumulated depreciation for 2 years. 1, 2. Because you want to find the accumulated depreciation so that you can get the carrying value on 1st July year 2. So you're trying to find out actually what is the accumulated depreciation here on 1st of July year 2. So if you do that, you go and take 10%. 10% is the percentage. 85,000 is the cost. So you will have 8,500 per year. Since you want to know for 2 years, you multiply by 2. So you will get 15,000. This accumulated depreciation, 15,000, is the one that you need to eliminate. Because when we revalue asset, the accumulated depreciation before the date of revaluation will have to be eliminated, since from the date of revaluation, we are going to provide depreciation based on the fair value. We are no longer going to provide depreciation based on the cost. So this 15,000, this 15,000 will have to be eliminated. How? How do we eliminate them? This is the journal entry that I'm showing here. So this is the first journal entry that you need to do. You are going to eliminate accumulated depreciation of what? Of the subsidiary that relates to the machinery of S. I put here of subsidiary. Sub for subsidiary. You are going to debit accumulated depreciation like what you have learned before. Machinery, 15,000, remove that. And credit the machinery, which is the machinery of the subsidiary, 15,000. And therefore, your carrying value now would be your carrying value would be 70,000. So if you compare the costs, you compare the fair value with the carrying value, you will now get the surplus. Why? Because fair value is greater than the carrying value. And the surplus here is a pre-acquisition surplus. It is a pre-acquisition surplus. And the surplus or the pre-acquisition surplus is 25,000. And for that surplus, you have one journal entry, which is to recognize the revaluation surplus, because this is revaluation surplus in the subsidiary company. So I put here sub. Therefore, you will debit the machinery of the subsidiary, 25,000 with the surplus, and you will credit the machinery of the subsidiary again, which is considered as pre-acquisition, 25,000. Right? So that one will have to be later adjusted in the fair value of net asset. We'll have to put this in the calculation of our fair value of net asset, because the surplus is a pre-acquisition surplus. For the adjustment of surplus, it will also be reflected in the consolidated statement of financial position, because machine is an asset. So we'll have to go and add to the machine, because we debit the machine with the surplus. So that one will be done later. Okay, the next step is for you to do the adjustment for depreciation. Why do we need to adjust depreciation? The reason is because the depreciation of the parent and the depreciation of the subsidiary are not the same. Subsidiary earlier was depreciating it based on costs. The group, which is the parent company, has been doing it at fair value. And for the purpose of consolidation, we need to go and make adjustment to the difference in depreciation. So let us look at what subsidiary have done for the 2 years after being acquired. The subsidiary was depreciating based on costs. So they are using 85,000, which is at cost. But for the parent company, since they have revalued the asset, the parent company is depreciating it based on the FV, or the fair value, 95,000. So 10% for 2 years. Because of that, there are difference in the depreciation between these two companies. The difference of how much? The difference of 2,000. And we are actually doing depreciation as to the point of view of the group. So we will have to see that group is depreciating at 19,000 and the subsidiary is depreciating at 17,000. So there was an adjustment for depreciation that the parent need to do to reflect that, where the parent need to provide additional depreciation because the subsidiary has under provided the depreciation by 2,000. Because there was an under provision of depreciation, we need to go and provide more depreciation. When we provide more depreciation, we are going to go and charge to the profit or loss. So here, because we are given the retained profit, so we are going to charge it to the profit or loss. We are going to put it debit retained profit of the subsidiary because providing more depreciation. So this is to adjust for the depreciation. And credit accumulated depreciation. So when you go and debit to the retained profit of the subsidiary company, it means that you are providing more expenses. So that reduce the profit. So that will be adjusted in the schedule. And for the accumulated depreciation that you credit here, that will be adjusted in the consolidated statement of financial position under the asset section. If you look at what I put here, next to the note, next to adjustment number 3, I put a note here. Okay, in our case, we have the asset being shown at cost less accumulated depreciation. In certain cases, you will see that assets are not shown at cost or shown at accumulated depreciation separately. You may have cases where assets are shown at carrying value. For that reason, depreciation adjustment, if you have, you need to make, and that one will be made against the carrying value of the asset because there are no costs or accumulated depreciation available. You will directly adjust the depreciation or the over or under provision of depreciation to the asset account. In this case, it is an under provision because it is a surplus. So surplus will lead to under provision of depreciation. This is a surplus. So if you have no information regarding costs or accumulated depreciation separately, this will be your journal entry. But for this example, we will make use of this journal entry. This is in case you have no information on cost and the accumulated depreciation. So you will directly adjust against the carrying value. Next. So that one will have to be reflected in your working schedule, in your schedule, and also in the 6 of P. But okay, now let's look for building. The same thing for building. You have the date of acquisition, the same date, the reporting date. You have the cost of the building, and the cost of the building I took from the SOFP of the subsidiary. You can check the SOFP of the subsidiary shows the cost of the building, the one of the subsidiary, to be 280,000. This one. This is the figure that I have taken, and this is the accumulated depreciation for the building. So they are given separately. So I put it here so that easy for us to refer. Okay, so that is the accumulated depreciation. This is the reporting date, as I mentioned to you, 30th of June. The remaining useful life were given to you here. Remaining useful life given in the question. If you read the question carefully, you have this information given here. Remaining useful life was 5 years, and that was on the date of acquisition. So on the date of acquisition, this is the date of acquisition, remaining useful life was 5 years. Right, now, what do we need to do? We will repeat the same thing again, which is we're going to find out what are the fair value. The fair value given in the question was 200,000. Where is it? It's here, 200,000 in the question. Then go and find out again the carrying value. Find out the carrying value. So to find the carrying value, you will have to find the cost and adjust it with the accumulated depreciation. So if you were to find the carrying value, cost less accumulated depreciation, the cost was 280,000. The accumulated depreciation that you have to find is on this date again. So you need to find the carrying value here, how much, as well as you need to find what is the accumulated depreciation here. So you need to do that. So to do that, this is the working. So to find accumulated depreciation, which is the figure here, we need to do some working. So the accumulated depreciation given to you was the accumulated depreciation here, which is on 30th of June. To find the one as at 1st of July year 2 here is for you to take the one given here, 196,000, and add back, you have to add back 2 years, sorry, not add back, sorry, reduce with 2 years depreciation, because in the later years depreciation get to be more. So in the earlier years the depreciation are less. So therefore you're going to take 196,000 and go and minus the 2 years depreciation. Why? You need to remove the 2 years depreciation since you want to know the depreciation or accumulated depreciation on the 1st of July year 2. So if you do that, right, the remaining useful life here is 5 years, remaining useful life here is 3 years. So that is why you take 84,000. 84,000 is actually the carrying value. So the carrying value, which is 84,000, 84,000 divided by 3, the remaining useful life, times 2. 2 years times 2, you will get the figure 196 minus the 2 years depreciation. You will get 140, which is the accumulated depreciation that you need to remove from the record as at 1st of July year 2. So this is the one that you need to eliminate. How much? 140,000. 140,000. So what is the journal entry? The journal entry is to debit the accumulated depreciation 140,000 and credit building subsidiary 140,000. So that will affect your SOFB, right? For the accumulated depreciation being eliminated. And the carrying value here would now be 140,000 as well. This 140,000 is as a result of taking the cost, the fair value minus the carrying value. So carrying value 240 minus 140, you have 140, and because of that your surplus is 60,000. That is your surplus, 60,000. And again, this is journal entry number 4 for this elimination. And for elimination, you do that. This is to record the surplus. Record the surplus just like what you have done before in your learning of MFRS 116. You will recognize the surplus, but bear in mind this is a pre-acquisition surplus. Pre-acquisition surplus. So 60,000. And this will affect your fair value of net asset calculation. And in case you are not given the asset at cost minus accumulated depreciation, right? You are just given at a carrying value, so you do not need to do this adjustment of elimination. So elimination of accumulated depreciation is not needed if that is using the carrying value as the information to start with, right? So the first adjustment here, the second adjustment is here. This is the third one for the recognition of under provision, and that was for the first item. For the second item, we start with number 4 here. Number 4 is to eliminate accumulated depreciation. Number 5 is for you to go and recognize the surplus arising on the acquisition date. And number 6 is for us to adjust the depreciation. For depreciation, as I mentioned, there are different depreciation done by group and depreciation done by the subsidiary. So for the group, they base on the fair value. For the subsidiary, they have depreciated based on the carrying value, because this is using remaining useful life. So they have been using the carrying value, 140,000, the carrying value. Now, what is the figure here? It is 80,000, and this 80,000 reflect what group has done, 80,000, which is 200,000 the fair value divided by 5 years. 5 years is the remaining useful life, times 2 because it has been 2 years since the date of acquisition until the reporting date. For the subsidiary, it still provide depreciation based on a carrying value, not at fair value. So they are using the carrying value of 140,000, 5 years, the remaining useful life, because the carrying value here is 140, we have already calculated. And the accumulated depreciation here, as we have calculated just now, was also 140. It happened to be the same because it has the same figure, but the calculation was different. So this 140,000 is this, but we are referring to this 140,000 here. So you can see the arrow that I put there. And therefore, for the subsidiary, they are providing at 56. So it has been an under provision again by the subsidiary company. and that under provision of the depreciation was by 24,000. Right. So to recognize that additional depreciation, what you would do is you are going to go and provide more depreciation, debit retained profit, or the profit or loss of the subsidiary, 24,000 with the difference in depreciation, and credit accumulated depreciation building of the subsidiary with 24,000. This adjustment will be done in the software. This one will be done in the schedule. And in case you do not have the accumulated depreciation account, that will be adjusted directly against the building account if the building account is at carrying value. So building at carrying value, I put that, of the subsidiary, in case that is not available. So you will still do the same adjustment. If that is an under provision. If this is an over provision, you will do the vice versa. Under provision means you will just switch the journal entry, and if it's under provision. For over provision, you will have to understand that that will only arise if there is a deficit. For deficit, it will lead to over provision. For surplus, it will lead to under provision. For deficit, if you come across later, you will have to reduce the depreciation. Okay, I will continue with the next explanation, which is the calculation of goodwill, which will also involve other calculation of schedule, and also the thing related to internally generated asset that we have not recognized in my next video. I'll see you when I will see you. Thank you for watching.